A recent webinar looked at how AM Best analysts evaluate mortgage risk covered by reinsurance based on a new criteria procedure. The analysts looked at risk charges associated with mortgage risk ceded to reinsurers by private mortgage insurers and the two government-sponsored enterprises, Freddie Mac and Fannie Mae, and on elements of best capital adequacy ratio that apply to mortgage risk.
There are approximately 15 reinsurers that cover PMI risk. And in total, altogether, I think 12 companies cover both the CRT programs and the PMI insurers. We spent a lot of time in our ratings criteria discussing reserves risk, and the reason is really quite simple. According to industry practice and statutory accounting rules, loss reserves are typically established only for loans in default, and loans are defined as being in default when they're at least 60 days or more delinquent. This is problematic because losses can develop from loans not currently in default. So what we need is a framework for calculating ultimate losses in a pool of loans until the last loan in that pool matures. And for that framework, we need a new nomenclature. We've established the nomenclature of B5M, which is mortgage-related reserves risk. And that has two components. B5CM, which is reserves risk associated with the current book of mortgage business, and B5FM, which is reserves risk associated with the book of business to be originated over a 1 year period. B5FM is effectively a net premiums written risk in our BACAR methodology. Together, these two B5s, B5CM and B5FM, make up B5M, which is the total mortgage-related reserves risk. We're going to spend a lot of time in this presentation discussing insurance of US PMI.
Thanks, Manny. So in this section, we will cover the B5M calculation for reinsurer of US PMI, where the loan level data is available. Currently, there are 6 active primary mortgage insurers in US, as illustrated in this slide. 3 PMIs who are no longer writing new business are not included in this list. Arch Mortgage Insurance acquired CMG and the operating platform of PMI in 2014. It also acquired UGC from AIG in 2017. Both Essence Guarantee and National Mortgage Insurance are the new entrants that get into the mortgage insurance after the financial crisis. This slide, we will present the premium ceded to reinsurers from the 6 active US PMI. The data that we are interested in are in column 1, column 3, and column 4. The column 1 is the gross premium written by the 6 active PMI. Column 3 is the premium ceded to non-affiliated reinsurers by these 6 active PMI. Column 4 is the ratio between column 3 and 1, which is the percentage of the ceded premium to non-affiliated reinsurers. As you can see in column 3, the ceded premium spiked up in 2016, which was the year that PMIERs, the private mortgage insurer eligibility requirements, going to be in effect. In other cases, reinsurers assume this risk may provide their views on the B5M to AM Best net of any retrocession agreements. We will discuss with the reinsurers about their risk evaluation process and their conclusions about reserve risk at peak stress levels. In some cases, we may use the factor-based approach if we think that's appropriate. If the reinsurer can provide loan samples or portfolio statistics, we can use the loan kinetics to calculate B5M based on some approximation of loan level data derived from the information provided. Just like that in previous section, B5M is the simple sum of B5CM and the B5FM. Well, this concludes the section, and now I'm turning over the presentation to Manny.
Thanks, Y. So far we've calculated B5M for the CRT programs. We've shown how to calculate B5M for the reinsurance of PMIs, and we've shown how to calculate B5M for other reinsurance programs. This slide shows the interaction of the various underwriting risk elements. You can see that we add B5CM and B5FM to get B5M, and then we put a 10% correlation between B5M and the non-mortgage related reserves, and B5 and B6 have zero correlation between them per our NRC formula. This is the new net required capital formula you see in our criteria. It incorporates the correlation between mortgage-related reserves risk and investment risk, which is the first box. It also incorporates the correlation between mortgage-related reserves risk and non-mortgage-related reserves risk, which is already embedded in the B5 number. So if there's no mortgage risk, this formula reduces back to our normal NRC formula for property and casualty companies. So this NRC formula, this new formula, is quite critical in the calculation of a BCAR score, which is a critical component in our balance sheet strength analysis. I'm now going to turn this presentation over to Steve Chirico, who will talk about the rating process.
Thanks, Manny. So Manny and Y just spent a lot of time talking you through how we calculate what is, in essence, an increase in net required capital to be input into our capital model, BCAR, and to result in the assessment of balance sheet strength. In a lot of ways, this type of analysis resembles what we do for terrorism stress tests and PML stress tests, and in some ways it doesn't resemble those things. I'm going to talk about, switching gears now, the four main verticals in the interactive rating process from an analyst point of view. As we all know, mortgage risk is highly correlated to the economy, and as well as certain risky assets, and we're then that is informing and driving our analysis both on the quantitative and on the qualitative side. So we expect a highly interactive discussion between the modeling that Manny and Y spoke to you about, our discussion with companies over enterprise risk management and business profile and the operating returns, and then how the reinsurer thinks about all of those things and how, from an organizational perspective, they have set risk tolerances, they have established early warning systems, and they have either grown or decreased the amount of mortgage business that they're writing at any one particular point in time and the reasons thereof. So we expect a highly interactive process. Frankly, the reinsurance organizations where we have been through this process with that have been actively writing mortgage for a period of time now, we find there's an extreme iterative process, more so than any other line of business. So we are going to ask companies for their definition of limit. We're then going to right-size that so that it's comparable against companies so that when we do our comparative analysis between reinsurers, we have a very clear definition of what the limits are and what the exposures the reinsurer is assuming is. And then finally, loan level detail where appropriate. I'll be frank and tell you that in typical AM Best fashion, we've been methodical and conservative with how we make assumptions in the rating process. And loan level detail can offer some incisive contemplation of how we're viewing mortgage in a particular portfolio and can lend some details as to how we should look at that. Everything else being accepted, again, we understand that we're being very conservative. We understand this market can be highly volatile, both from a capital perspective and an operating performance perspective. And a lot of these bits of information that we're gathering from a company help us identify where a company would fit from a comparative analysis perspective compared to other reinsurers.
You can view this webinar in its entirety at ambest.com.